My question is, if you were investing a small sum today, which approach would you use?
Well, I would use the approach that I think I'm using now of trying to search out businesses where I think they're selling at the lowest price relative to the discounted cash they would produce in the future. But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. You mentioned that 56 to 69 was the best period. Actually, my best period was before that. It was from right after I met Ben Graham in early 1951. But from the end of 1950 through the next 10 years, actually returns averaged about 50% a year. And I think they were 37 points better than the Dow per year, something like that. But that I was working with a tiny amount of money. And so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap. And obviously, as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it at that time. But I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically. But that's the nature of it. You've got to, when you get up to things you can put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals. And I did it twice. And I actually, looked at every business. I didn't look very hard at some. Well, that's not a practical way to invest tens or hundreds of millions of dollars. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. If you were, there's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money.
A lot of the criticism that many great investors get from the various comment sections on basically any investing platform is that they have a lot of money to use. It's not uncommon to find comments like, oh, they can only do that because they have billions of dollars to play with, or of course it's easy to do that with lots of money. Obviously, this comes from an uninformed perspective, but today I've decided to address that and show that even with little money, one can stand to gain a lot from the markets. And what better way to discuss getting returns from smaller financial amounts than from tapping into the oracle of Omaha's wisdom, Mr. Warren Buffett himself. Buffett is a self-made billionaire who started investing at the early age of 11 with barely any notable finances at all. If anyone knows how to take a dollar and turn it into multi-billions, it has to be him. So that's exactly what we are looking into today as we explore in depth how one can invest a small amount of money and make millions, if not billions, from it, according to Warren Buffett. If this is a subject that interests you, and if you have the desire to see your personal portfolio looking like a small hedge fund, then keep watching as I break down the approach that you should use following Warren Buffett's philosophy. Let's get right into it. There are several worthwhile steps that, if followed, will prove lucrative for you. Some of these are action steps that require applied effort from you. Some of these are conditioning steps that prepare you mentally and otherwise for the onset of opportunity. So, what does Buffett say about all of this? Let's find out.
The only way we know how to make money is to try and evaluate businesses. And if we can't evaluate a carbon steel company, we don't buy it. It doesn't mean it isn't a good buy. It doesn't mean it isn't selling for a fraction of its worth. It just means that we don't know how to evaluate it. If we can't evaluate the sensibilities of putting in a chemical plant or something in Brazil, we don't do it.
Okay, let's get this clear. When you have limited funds, investing is a tad more stressful. This is because every one of your dollars is precious, and that can be the barrier between you and financial ruin. What this means is that you have to be extra careful with your investments to preserve your capital. Unlike a multi-billion-dollar fund that can afford to take certain risks without getting crippled, with limited capital, you can't. Fully aware of this, Buffett says that in such cases, you should invest in financial sectors that you understand. By putting your money in markets that you are familiar with, you can give yourself the slight advantage of being able to understand what is going on with the respective companies of the stocks you own or wish to own. You might even be able to pick up on things before the rest of the market does, and this gives you an overwhelming advantage and room for flexibility. In a market where everything can be the deciding factor between profit and loss, you really would want that first-to-market advantage that comes with information. Alternatively, no matter how good an opportunity looks, if you are not well versed with the company and stock, don't invest at all. You would rather just pace yourself and let that opportunity pass while you wait for something you're better acquainted with. Like Warren Buffett always says, you can't lose money by not investing, but you can definitely lose your money by investing in the wrong thing. Wise words. Before we proceed to the next point, consider clicking the link in the description below and signing up for Webull. By doing so, you are not only getting access to the top trading platform, but as a sign-up bonus, you will get 2 free stocks to go with it. Right, let's move on with more of Buffett's wisdom.
Yeah, if I were working with small sums, I certainly would be much more inclined to look among what you might call classic Graham stocks, very low P's and maybe below working capital, all that. Although, and I would do far better percentage-wise if I were working with small sums. There are just way more opportunities. If you're working with a small sum, you have thousands and thousands of potential opportunities. And when we work with large sums, we have relatively few possibilities in the investment world that can make a real difference in our net worth. So you have a huge advantage over me if you're working with very little money, but there are compensations to that on the other side of the equation. The Korean stocks you mentioned that I looked at 6 or 7 years ago were companies where you could only put a small amount of money in, and I was sort of reliving my youth.
According to Warren Buffett, when investing with smaller capital amounts, you are exposed to more financial opportunities that you can capitalize on and make a lot of money quickly. Buffett even insists that in life, ratio-wise, he had more success when he was younger investing with smaller amounts back in the early 1950s. All this is because there are numerous wrinkles or cracks in the market that you can capitalize on that big businesses do not even pay attention to. One generalized tip regarding this is that you can find mispriced stocks in the market. Like anywhere else in the world where a buy and sell transaction might take place, some stocks are overpriced and some that are underpriced. A good market study will help you assess what's what. By looking at the financial ratios and reading reports, you can easily see which stocks are being underappreciated based on stellar company performances. Buffett, throughout his illustrious career, has advocated and highlighted the importance of studying. He has gone so far as to mention that his love for studying was when he had lesser capital and he would comb through thousands of pages of information just to get access to the best companies. Of course, in this day and age, I won't expect anyone to go through yellow pages anymore, but thanks to the advancements in information, even the general investor has huge insights now. It would be wise to use this to your advantage and maximize on what others aren't seeing as well. After all, they do say, one man's poison is another man's food. Also note that during times like now, when we have several sell-offs due to various factors I've talked about on other videos on this channel, there is a big opportunity to land good stocks that are way below book value and have low financial ratios. Buffett even states that this is something that you can do not only with small capital portfolios, but even in the bigger portfolios too. Value investing is one of his core strategies and perhaps what Oracle is best known for. A simple example is how Buffett bought Sea Candy's entire shares for $25 million in 1972, and now, 40 years later, Buffett states that the company has returned $1.65 billion in net profits. Talk about netting massive returns from what is relatively, in the context of such profits, a smaller amount.
Somebody sent me a handbook of Korean stocks and told me that the market was interesting. So one Sunday afternoon I did leaf through a couple thousand pages of Korean stocks, and I was sort of reliving my youth. I mean, you know, other people look through old Playboy magazines or something like that, but I looked through these old manuals of stocks, and I bought a number of stocks in small amounts from companies whose names I couldn't pronounce. But the stocks as a group were so cheap that you had to make money out of them. They were Graham type stocks, and that's what I would be doing. I would be combing that sort of a list. Now,
Warren Buffett and Charlie Munger have emphasized this point over and over again. The simple fact is that when you have smaller pools of capital, you are liable to get a bigger return ratio with the same expertise level. This is because you have access to select markets and access to select opportunities that the big capital pools don't have. Let me elaborate further on this. There are small securities markets that have high return potential. Unfortunately, or rather in this case, fortunately, small securities have a low volume of trades. That means larger hedge funds cannot trade in these circles, hence they don't even bother looking at these types of markets. You, however, with your small capital pool can trade in these spaces for some heavy returns. Like Buffett in the 1950s, you could be netting up to 50% in annual returns. Take that, Dow Jones. The reason he was able to get such high returns when he had little money was that he was able to take more risks. As your capital increases, you need to become more and more conservative and careful with your investment strategy. Losing 5% of $10,000 is much easier to recuperate than 5% of $1 billion. I've never lost 5% of $1 billion, but my whole body is recoiling at the thought of it. Buffett even said, if you're working with a small sum of money and are willing to do the work, there is no question that you will find some things that promise very large returns compared to what we will be able to deliver with large sums of money. Also, because the big players are not involved in small select security markets, it means that there are fewer players in those spaces and hence less competition. This means bigger pieces of the cake for the existing people, and it means less manipulation in the market. Honestly, you want to exploit these small securities markets. There's some good money there. Lastly, on this same point, there's one element to consider. Because these securities markets are not as covered in the media, the way the bigger markets are, they are seen as less speculative. Let's be honest, the CNN and CNBC coverage of bigger markets doesn't help much. There is a lot of volatility in these major markets. However, because these smaller securities aren't as covered, you'd be surprised at the level of stability and balance that they have. And normally, all that just flies under the radar. All these are opportunities that are somewhat limited to people with small pools of money, which, unlike in most cases, is oddly an advantage right now. One of the reasons Buffett has been so incredibly successful is because of the sheer amount of time he has spent in the markets. I mean, the man has been investing since he was 11, and now he's 91. Talk about commitment. This means that he has managed to benefit from the core of this point, compound interest. By starting early, you give yourself room to capitalize on compound interest, and you can be able to milk heavy returns over time. When you are in a place where you can profit and reinvest those profits, compounding them over some time, your returns will far outpace what you would have earned doing the things the regular way. Start early, Buffett has said. I started building this little snowball at the top of a very long hill. The trick to have a very long hill is either starting very young or living to be very old. There's a reason why Einstein, one of the most brilliant men to ever walk the face of the earth, said, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." Buffett clearly understands it, and I hope that you can leverage it for your portfolio. Okay guys, according to the Oracle of Omaha, having a small pool of capital isn't the end of the world. Actually, according to him, it's the start of a great big world where you have great opportunities to level up your capital pool. That small pool of funds will quickly get you to the big boys club. What makes this even more excellent is that these points aren't just theoretical, but they are actually proven by Buffett himself, as this is how he grew his wealth to become the biggest investor the world has ever seen. By following these points religiously, you too can get yourself on the path of extreme wealth. I mean, a few more zeros to your bank account wouldn't hurt now, would they?